Welcome to Part 3 of the USDA New Lender Training Course for the Single Family Housing Guaranteed Loan Program. The New Lender Training Course consists of 5 parts. In Part 3, we will discuss the requirements of credit analysis and ratio analysis. Once you've completed viewing all 5 parts of the New Lender Training Course, you will be ready to complete the required knowledge quiz through the link provided by USDA to your organization's point of contact. You must receive a passing score to consider this training complete. You may take the quiz as many times as needed. The next key topic we are going to take a look at is credit eligibility. As USDA lenders, comprehending the regulations that oversee our program is crucial for ensuring consistent compliance. Nonetheless, it is vital to acknowledge that the final decision-making power rests with each lender. Although adherence to regulatory guidelines is necessary, lenders possess the freedom to exercise their own judgment informed by their expertise and market insights. By staying well informed about industry regulations and applying their professional judgment, lenders can correctly maneuver through intricate lending situations while prioritizing the best interests of their clients. The first topic we are going to cover is the requirements of credit score validation. For GUS loans, GUS will determine the acceptable credit score. If an acceptor accept with full documentation recommendation is returned, no credit score validation is required. For loans that receive a refer or refer with caution recommendation and manually underwritten loans, credit score validation is required. At least one applicant whose income or assets are used for the loan must have a validated credit score. This applicant needs to have 2 trade lines on their credit report that have been open for at least 12 months based on the account opening date shown on the report. Keep in mind that a validated score does not mean the applicant has a good credit history. It only shows they have a minimum eligible credit history. Eligible trade lines for validating the credit score can include open, closed, or fully paid accounts, as long as there is a payment history. These can be secured or unsecured loans, revolving accounts, installment loans, credit cards, collections, charge-off accounts, and more. If a credit report has no score, it must meet non-traditional trade line requirements. Applicants without a conventional credit history or a validated credit score can demonstrate their ability to meet debt obligations through alternative means with non-traditional credit. A non-traditional credit history alone does not justify a loan denial. Ultimately, it is a lender's duty to assess whether the loan aligns with agency guidelines and represents an acceptable credit risk, regardless of the GUS recommendation. For applicants with a 12-month verification of rent, 2 trade lines are necessary, the VOR and 1 additional eligible trade line from the credit report with a 12-month history or an acceptable non-traditional trade line. Applicants lacking a rent history must provide 3 trade lines, which can be a mix of traditional trade lines from the credit report with a 12-month history or eligible non-traditional trade lines. Non-traditional credit can be documented in several ways: a non-traditional mortgage credit report, self-reported trade lines on a traditional credit report, or documentation from third-party verifications, such as canceled checks, money order receipts, electronic payment records, payment histories from creditors, or bank statements that clearly show debit payments for services or products. An eligible non-traditional trade line must have a 12-month history and should not have been closed more than 6 months before the loan application. Acceptable non-traditional credit sources include, but are not limited to, renter housing payments, utility services such as gas, electric, water, landline telephone service, or cable TV, provided these services are not included in rent payments. A recent update now allows monthly subscription services such as gym memberships to be considered as an eligible source as well. Next, we're going to talk about addressing significant adverse credit that, unless remedied, may render your applicant ineligible for a USDA loan. The first topic of significant adverse credit we are going to talk about is delinquent federal taxes. Taxpayers who owe taxes and do not pay in full by the filing date are determined delinquent by the IRS. An IRS-approved extension to file a tax return does not grant the applicant additional time to pay their taxes due. Applicants must pay their estimated income tax due by the IRS filing date, or they are determined delinquent by the IRS. So how do you proceed with these cases? An applicant that has owed taxes on previous filed returns exhibits a pattern of taxes due. Therefore, an estimated tax payment must be made to the IRS by the specified deadline. The applicant may file their return at a later date and still remain eligible for a guaranteed loan if that payment is made. Now, if an applicant has received tax refunds for previous filed returns, they may remain eligible with no payment due because they would not be determined to be delinquent as they historically have not paid in. An applicant with delinquent federal tax debt is ineligible unless they have proof of an approved IRS repayment plan. A minimum of 3 timely payments must have been made on each active repayment plan, and the applicant may not prepay in lump sum at one time to equal 3 monthly payments to meet this requirement. While an applicant with multiple approved IRS repayment plans are eligible, the approved lender's underwriter must review and determine if the applicant is an acceptable credit risk. A non-tax federal debt is a debt owed to the U.S. federal government other than federal income taxes. Federal debts are typically discovered when the lender reviews the Waivers results, credit report, public records, or equivalent. An applicant with a delinquent federal non-tax debt is ineligible unless the debt is paid in full or a release of liability is documented. Applicants presently delinquent on court-ordered child support payments are ineligible unless the following are met. For child support payments that are subject to the collection by an administrative offset, the applicant must demonstrate that they have brought the payments current, the debt is paid in full, or otherwise satisfied by a documented release of liability. For child support payments not subject to an administrative offset, the applicant must provide documentation that an approved repayment agreement is in place and 3 timely payments were made prior to loan closing, or the arrearage is paid in full prior to loan closing, or a release of liability is documented. Credit exceptions are never required for GUS accept loans, but for others such as those receiving a refer with caution underwriting recommendation, they may be required. So let's take a look at what is required in those situations. For GUS refer with caution, and manually underwritten files, credit exceptions would be required in cases of foreclosures, bankruptcies, deed in lieu, and short sales less than 36 months, and when there has been a 30-day late rent or mortgage payment in the last 12 months. Regardless of the GUS recommendation, it is the approved lender's responsibility to review and determine the loan meets agency guidelines and is an acceptable credit risk. These are the agency's minimum guidelines. Lenders may have additional overlays or more stringent credit requirements. Credit exceptions are not required for instances such as overdrafts, Chapter 11, 12, and 13 discharged or completed more than 12 months, charge-offs, collections, or other examples listed on this slide. However, remember it is the approved lender's responsibility to review and determine the loan meets agency guidelines and is an acceptable credit risk. Again, these are the agency's minimum guidelines. Lenders may have additional overlays or more stringent credit requirements. Now, there are a few instances of adverse credit that a lender cannot waive, and those include delinquent non-tax federal debts, delinquent child support, and an ineligible Waivers result. In cases where there was a previous USDA loss that occurred within 7 years of the loan submission date, only USDA can waive that adverse credit. In those situations, you will proceed as usual with a full underwriting review of the loan. Explain and document the circumstances that led to the loss paid on their behalf. Be sure to provide supporting documentation and a recommendation for loan approval, along with the final and complete application submission to USDA. The lender's approval recommendation should include an explanation of positive aspects of the loan file, which would attribute to future homeownership success. USDA will review the explanation and supporting documentation and make the final determination of the applicant's eligibility for a new guaranteed loan. As you've now seen, guaranteed loans allow for flexibility in credit analysis. That's why it's so important to always communicate with your underwriter. We know there are unique and non-recurring circumstances, and we recognize the ability of our lending partners' experienced underwriting staff to make credit exceptions. USDA does not make the credit decision. The lender's underwriter has that responsibility. When making exceptions, we expect that the underwriter demonstrates the issues were temporary in nature, beyond the applicant's control, and unlikely to recur. For example, an applicant that previously said they had a lesser paying job but now have a great job, we would not want to see that they have worked for the same employer and in the same position for the last 25 years. So make sure the documentation in your file makes sense and supports your decision. Make sure it connects the dots. Remember, the one exception a lender cannot make is for a previous USDA loss in the past 7 years. Only USDA can make that determination. Although waivers are not required for all types of adverse credit, these factors could have a negative impact on the applicant's credit accounts and repayment of the proposed mortgage debt. Therefore, the lender should evaluate all adverse credit in their credit decision. Next, we're going to highlight a few of those factors to always take into consideration in your overall credit risk analysis. Let's begin by taking a look at how to handle collection accounts for USDA loans. The underwriter must review all collection accounts and determine if the applicant is an acceptable credit risk, regardless of the GUS underwriting recommendation. In reviewing collection accounts, USDA does not require medical collection accounts to be paid. If the cumulative total of all non-medical collections exceeds $2,000, lenders will need to either 1. Require payment in full of these accounts prior to loan closing, 2. Use an existing repayment agreement or require payment arrangements be made with documentation from the creditor and include the monthly payment, or 3. Include 5% of the outstanding balance as a monthly liability amount. No further documentation is required when using this amount. All open collection accounts on the credit report must be listed on the GUS Liabilities page. When completing the GUS data entry for collections that will be paid at or before loan closing, lenders should select the checkbox that states to be paid off at or before closing. If the collection is not required to be paid in full, the lender should select the omit checkbox and provide an explanation in the additional data entry pop-up box as to why the debt will be omitted from ratio consideration. If a repayment agreement has a specified monthly payment, include that amount. Do not simply enter $1 in the monthly payment data field. You must enter the actual payment amount. After USDA has issued a conditional commitment, but before the loan is closed, lenders may uncover additional debts or higher payments of existing obligations. These newly identified debts or increased payment amounts were not included in the loan application sent to USDA and could encompass a variety of obligations, including installment loans, revolving credit accounts, property taxes, and final homeowners insurance premiums. In these cases, if the cumulative debt amount is $50 or less, the lender may retain the issued conditional commitment. The lender must retain all documentation to support the new or increased debts and payments in the permanent loan file, and no further action is required. Now, if after reviewing the debt changes, the cumulative amount is $51 or more, lenders must request the GUS loan to be released back to them by USDA. The lender must enter the new debt or increased payment amount and retain all documentation to support their data entries. A new preliminary underwriting submission must be completed to confirm the GUS underwriting recommendation. Lenders must upload all supporting documentation and complete a new final underwriting submission. USDA will then issue a new conditional commitment. As a reminder, lenders cannot close loans without a valid conditional commitment. A verification of rent is not required for applications that receive an accept GUS underwriting recommendation. For those that receive a refer or refer with caution GUS underwriting recommendation or manually underwritten files, a verification of rent may be necessary. Lenders will need to check the GUS underwriting findings report to see if a verification of rent is needed. All housing payments recorded in GUS must be properly verified and documented. Applicants without a verifiable housing payment history are not automatically disqualified. the underwriter must assess the available documents to decide if the applicant has a suitable credit history and meets program requirements. If there is one rent or mortgage payment that was more than 30 days late in the last 12 months, it is seen as significant derogatory credit and will need a credit exception approved by the lender's underwriter. Attachment 10A can be found in Chapter 10 of Handbook 1, 3555. This is an excellent tool to assist you during your underwriting review. The next key to eligibility we're going to highlight is ratio requirements. Ratios are derived from the repayment income as specified by the lender in Chapter 9 of the Handbook. The PITI ratio encompasses several components, including the first mortgage, any subordinate liens, homeowners insurance, supplemental property insurance, property taxes, the USDA annual fee, association or project dues for condominiums, co-ops, or PUDs, as well as other housing-related expenses. For the total debt ratio, applicants are deemed to possess the capacity to repay when their cumulative debt amounts to no more than 41% of their repayment income. The total debt ratio encompasses the monthly housing expenses in addition to any other monthly credit or debt responsibilities. The lender must document the applicant's debts using records such as credit reports, direct or third-party verifications, court documents, or deposit verifications. All open debts and accounts incurred through the closing date, including non-medical collection accounts and judgments, must be taken into account in the total debt calculation and documented in GUS and the loan application. The amounts on the credit report will be used unless there is verification for a different payment amount. If a different amount is used, the lender must provide documentation for the amount used and upload the documentation with the final submission to USDA. For accounts with fixed payments such as auto, personal, secured, or unsecured loans, include the monthly payment. If there are 10 or fewer months remaining, the monthly debt may be omitted as long as it is less than 5% of the monthly repayment income. The remaining debt for installment debt can be paid down and reduced to 10 months or less. It's important to remember that regardless of an account's balance, if it is being omitted, you must verify that it doesn't exceed 5% of the applicant's repayment income. For revolving accounts such as credit cards, lines of credit, and secured and unsecured loans, lenders must include the minimum monthly payment documented on the credit report or other creditor verification in the total debts. If the credit report shows an outstanding balance, but no minimum monthly payment, the payment must be calculated as 5% of the balance reported on the credit report. The lender may obtain a current account statement or creditor verification to document the actual monthly payment and include that amount in the monthly debts. Revolving accounts with no outstanding balance on the credit report do not require an estimated payment to be included in the debt ratio. Revolving accounts with no outstanding balance are not required to be closed. Now, if an applicant has outstanding student loans, regardless of the payment status, lenders must include the following payments. When the payment amount is above zero, use the payment amount reported on the credit report or the actual documented payment. When the payment amount is zero, use 0.5% of the outstanding loan balance documented on the credit report or creditor verification. Student loans in the applicant's name alone, but paid by another party, remain the legal responsibility of the applicant. Student loans in a forgiveness plan or program remain the legal responsibility of the applicant until they are released of liability from the creditor. In these cases, the applicable payment must be included in the monthly debts. For co-signed debts, those must be included in the monthly debts unless the applicant provides evidence another party to the debt has successfully made the payment for the previous 12 months prior to loan application. Acceptable evidence includes, but is not limited to, canceled checks, money order receipts, or bank statements of the other party. Late payments reported in the previous 12 months prior to application will require the monthly liability to be included in the monthly debts. If the applicant can provide conclusive evidence from the creditor that they will not pursue debt collection against the applicant should the other party default, the 12-month payment history of the additional party is not required. Debts identified as individual on a credit report must be included in the debt ratio, regardless of who is making the monthly payment. For example, if parents are paying car payments on behalf of the applicant and the loan is solely in the applicant's name, in this situation, the payment must be included. Court-ordered debts must have the payment included in the total debt ratio unless the applicant has a release of liability from the court or creditor and acceptable evidence is documented. Lenders will utilize select pages from the applicable agreement or court order to document the required monthly payment due and the duration of the debt. Court-ordered debts with 10 or less payments remaining may be excluded if the payment does not exceed 5% of the monthly repayment income. For GUS transactions, the lender will manually enter the obligation as a monthly liability. When the obligation account is entered as other, the lender will specify what the obligation is, such as court-ordered child support, alimony, garnishment, etc. A manual entry of this monthly obligation type does not require an underwriting recommendation of accept to be downgraded to a refer. Lenders must confirm repayment agreements are current. Lenders can refer to Chapter 10 of the Handbook for court-ordered debt guidance and program eligibility. Let's review what's required when an applicant currently has a mortgage liability. For mortgages of a rental property, income received from rents may only be counted for repayment if received for 24 months or more. Rental income must be included in annual income regardless of the length of time received. If the credit report reflects late mortgage payments on the rental property in the 12 months prior to loan application, the full mortgage liability and all associated costs must be included in the monthly debts. Mortgage liabilities disposed of through a sale, trade, or transfer without a release of liability, so the borrower remains on the promissory note, must be included in the total debt ratio unless evidence can be obtained to confirm the remaining party or new owner has successfully made the payment for the previous 12 months prior to loan application. Evidence may be reported through the credit report or verification from the creditor or servicer to document the payment history has been current for the 12 months prior to loan application. If there are late payments in the previous 12 months prior to loan application, the full mortgage obligation must be included in the monthly debt. In the case of a divorce, the lender must obtain a copy of the legal separation agreement or divorce decree to document the remaining party responsible to pay all mortgage debts from the effective date of the decree forward. To exclude the mortgage debt, the lender must document the previous 12 months have been paid as agreed prior to loan application through the credit report or verification from the creditor or servicer. If there are late payments in the previous 12 months prior to loan application, the full mortgage obligation must be included in the monthly debts. Business debts such as a car loan reported on the applicant's personal credit report may be omitted from the monthly debt if there is evidence the debt is paid through a business account. Acceptable evidence includes canceled checks or bank statements from a business account for the previous 12 months. Please note this recent update to Chapter 11. Payments paid by the business must be included on the cash flow analysis and/or profit and loss statement when applicable. When applicants are purchasing in a community property state, debts of a non-purchasing spouse must be included unless excluded by state law. The lender must cite the specific state statute in the permanent case file. Approved lenders are responsible to confirm state laws are met. Community property states include Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. In this next section, we're going to take a look at what is required for debt ratio waivers.
GUS files that receive an accept or accept full documentation underwriting recommendation do not require a debt ratio waiver. Submissions that receive a GUS recommendation of refer or refer with caution and loans that are not supported by GUS must have documentation supporting eligible compensating factors to support a debt ratio waiver. The applicant's PITI ratio may exceed 29% and the total debt ratio may exceed 41% if the lender determines that strong compensating factors demonstrate that the household has higher repayment ability. The lender must document eligible compensating factors to support a debt ratio waiver. Agency approval of a lender's request may be granted if all of the following conditions are met. The maximum PITI ratio cannot exceed 32%. The maximum total debt ratio cannot exceed 44%. The validated credit score of all applicants is 680 or greater, and at least one of the acceptable compensating factors listed in Chapter 11 of the handbook is identified. Those compensating factors include accumulated savings or cash reserves available post loan closing are equal to or greater than 3 months of PITI payments. Cash on hand is not eligible. The applicants, which includes all employed applicants, have been continuously employed with their current primary employer for a minimum of 2 years. Applicants that have received Social Security benefits or retirement income for 2 years may utilize this compensating factor with documentation to support the history of receipt of benefits. This compensating factor is not applicable for self employed applicants. The proposed PITI does not exceed the applicant's current verified housing expense by more than $100 or 5%, whichever is less, for the 12-month period preceding loan application. No more than one 30-day late payment for the previous 12 months. And lastly, the subject property is an energy efficient home based on the IECC standards. The lender is responsible for verifying and documenting evidence in the permanent loan file to meet this requirement. Next, we're going to talk about debt ratio waivers for refinance transactions. Gus files that receive and accept full documentation underwriting recommendation do not require a debt ratio waiver. Submissions that receive a Gus recommendation of refer or refer with caution and loans that are not supported by Gus require debt ratio waivers, and supporting documentation must be submitted to USDA. There is an exception. Streamline Assist refinance loans do not require debt ratio calculations. Therefore, no debt ratio waiver is required. Debt ratios for refinance loans are not limited to the maximum purchase debt ratio thresholds.
The following are examples of acceptable compensating factors for debt ratio waiver requests for refinance transactions. A validated credit score of 680 or higher for all applicants. The proposed PITI does not exceed the borrower's current verified mortgage payment by more than $100 or 5%, whichever is less, for the 12-month period preceding loan application. Accumulated savings or cash reserves available post-closing are equal to or greater than 3 months of the proposed PITI payment. Cash on hand is not eligible for consideration as a compensating factor. Continuous employment with the current primary employer. The subject property is an energy-efficient home defined as a dwelling which meets or exceeds the current IECC. Refer to Handbook 1 3555, Chapter 11 for further information on what qualifies as meeting or exceeding the current IECC standards. For detailed information on waiver requirements and other ratio guidance, refer to Chapter 11. This concludes Part 3 of the new lender training course. You can now proceed to Part 4, where we will discuss property requirements as well as new construction and manufactured housing.